Timing the market is tough. It's a tough endeavor. And inevitably, if you're working as an investor and you sell something and then prices jump up, you can look back and say, I failed. Or the opposite, you failed to sell and then the market dips down and you have an asset that you no longer want. Real estate is a slow moving asset. It's difficult to acquire, it's difficult to sell. And so timing the market can be difficult. There are some general rules of the real estate market where you can track different trends, right? Historically, people are going to move in the spring, summer, and fall, then more so than they are in the winter. And so if you're looking at it from the standpoint of, well, I'm going to sell in the next 12 months, and you have a plan to sell in the next 12 months, I wouldn't wait until the winter. I would do it either before winter comes or after winter ends. Okay. If you don't have a choice and you're in a position where you get a job transfer or you just have to go, you have to just deal with what the market's going to give you at that time. From an investor standpoint, if you're looking at timing the market from an acquisition side to a sales side, it's important to look at different market indicators. But since it's impossible to time everything perfectly, when you invest in real estate, I always like to have multiple exit strategies. So let's say I'm buying a flip and I'm looking at the market and I say, I think I can sell it for a good profit. And then the market starts to shift. You should have a couple of backup plans. One backup plan might be selling it on a real estate contract. There's a little bit more options, maybe more buyers that you could appeal to. A third option might be you're going to keep it and you're going to rent it out. And you're going to have a property manager manage it. And even though you're not making as much money as you originally intended, you still have a way of building long-term wealth. So I think it's important to always have multiple exit strategies. Alternatively, if you say, hey, I'm going to buy this asset and I'm going to rent it out, and then something happens that your life circumstance change and you need to liquidate, you need to have exit strategy in reverse. So if your plan is to rent out and that plan crumbles, then you can backtrack and say, okay, well, instead of renting, I'm going to sell on a real estate contract. Instead of that, I'm going to actually just sell it outright and free up capital. So it's probably impossible for the average person. It's possible for me to time the market. I've been buying and selling real estate for almost 2 decades. And it was really difficult during COVID. I had a handful of rental properties, and the way that economists were talking in the early parts of 2020, I mean, the sky was falling. Let's go. If you own assets, you got to sell it. Because the government printed so much money and inflation ramped up, one of the best protections against inflation is real estate. And so what ended up happening is real estate prices soared, cost of living soared, which happens during inflationary periods. So I did a combination during that time. I liquidated some of my rental properties because I had a large capital project that I was working on and I needed the cash. I was also a little scared. But during that time, I was also buying a lot of assets. So I was hedging my bet against being wrong, which I ended up being very wrong. And had I kept a handful of those rental properties, they continued to increase in value. But during that time, I was also buying property that I was getting equity in. So I think it's important not to get hung up on one single success or one single failure. Building real estate wealth over a long period of time takes a lot of tenacity and it takes a lot of endurance. And so if you make a mistake, it's not worth quitting over. I know several people that have failed to time the market, like they sold too early or they bought something at the height and then values dropped, and then they never get back in the game. They never start reinvesting again. The same thing happens in the stock market. Somebody invests $5,000 and then it gets cut in half, they sell it and they never invest. Well, meanwhile, 5 years later, that $5,000 investment would have been worth 10 or 20 now, right? But they sold it at the time when they were fearful. So I think operating in a position of fear and regret is like just those emotions and those feelings, generally, they're not going to propel you forward. Fear and regret are going to hold you back. And so even if you make a mistake and you sell an asset when you should have kept it, or you kept an asset when you should have sold it, I think the idea is that you're learning a lesson. Education is never free. And so you're taking that cost and you're saying, okay, I'm not going to do that again. I'm going to look at maybe some of these other factors that I didn't think of, and I'm going to use those factors to make educated decisions on my investment portfolio. So timing is impossible to get perfect, but it's an exercise and a practice that could take a lifetime. And I guarantee if you stick with it in real estate, the longer, the better. The longer you hold something, the better it is. Timing is less important with long-term holds. And so just make sure that you're supplementing your short-term investments with some long-term investments and you're going to be doing just fine. Hey everyone, Michael here with Absolute Real Estate. Thank you for watching. Do me a favor, like and subscribe below. And if you want more information on real estate and real estate investing, check out the links below, and I'll see you on the next video.